You know what keeps me up at night? It's not the stock market. It's not even the national debt anymore. It's watching the very foundation of our monetary system crack in real time, while most people scroll past it like it's just another headline. Let me tell you what happened 3 weeks ago that nobody's talking about. The Federal Reserve's balance sheet hit a critical inflection point. They've been trying to reduce it, right? Quantitative tightening. Sounds technical. Sounds boring. But here's what it actually means. They're trying to pull money out of the system while simultaneously the Treasury Department is issuing debt at a pace we've never seen before. Someone's got to buy that debt. And when the Fed steps back, who steps in? Nobody. That's the problem. We're watching a game of musical chairs where the music's about to stop and there aren't enough seats. The Treasury's issuing bonds. The Fed's not buying them like they used to. Foreign central banks are actually net sellers now. So who's left? Domestic buyers who are looking at these yields and doing the math. And the math doesn't work when inflation's running hotter than the official numbers suggest. I was talking to a fund manager last week, guy who's been in the business for 30 years. He told me something that made my blood run cold. He said, "We're not in a normal market anymore. We're in a managed decline." Think about that phrase, managed decline. That's not conspiracy theory talk. That's a professional investor with billions under management telling me that the people in charge know the system's breaking. They're just trying to control how fast it breaks. Now, here's where gold comes into this story. And I'm not talking about gold as some shiny rock people buy because they watch too many YouTube videos. I'm talking about gold as the only asset in human history that's survived every single monetary reset. Everyone. The Roman denarius collapsed. Gold survived. The British pound lost its reserve status. Gold survived. The Weimar Republic printed itself into oblivion. Gold survived. You want to know what's really happening right now? Central banks are buying gold at a pace that would have been unthinkable 5 years ago. The World Gold Council just released data showing central bank purchases hit 1,037 tons last year. That's the second highest year on record. But here's the kicker. They're not announcing these purchases anymore. They're doing it quietly. The People's Bank of China reported zero gold purchases for months, then suddenly announced they'd been buying the whole time. Why the secrecy? Because they know something. They know that when you announce you're moving away from dollar reserves, you trigger the very crisis you're trying to protect against. So they're doing it slowly, methodically, like someone trying to sneak out of a room without waking the sleeping giant. Let me paint you a picture of what's happening in the physical gold market right now. The COMEX, that's the big futures exchange in New York where gold gets traded. They've got this thing called the deliverable inventory. That's the actual physical gold sitting in their vaults that can be delivered against futures contracts. 3 years ago, that number was comfortable. Today, it's at levels that would trigger alarm bells if anyone was paying attention. Here's how the game works. For every ounce of physical gold in the COMEX vaults, there are roughly 100 ounces of paper gold trading. Futures contracts, options, ETFs, all these financial instruments that say they represent gold but are really just promises. And that works fine as long as nobody asks for delivery. It's like a bank run in reverse. As long as everyone believes their paper gold is as good as physical gold, the system holds together. But what happens when that belief cracks? We got a preview in March of 2020. Remember that? The pandemic hit, markets went haywire, and suddenly there was a massive disconnect between the paper gold price in New York and the physical gold price in London. We're talking $70 per ounce difference at one point. That's not supposed to happen. Gold is gold, right? Except when paper gold and physical gold start trading at different prices, that's the market screaming that something's broken. They papered over it. The Fed stepped in, provided liquidity, flew physical gold across the Atlantic on chartered planes. Crisis averted. But here's what nobody talks about. They didn't fix the underlying problem. They just kicked the can down the road. And that road's running out. Now, I want to take you back to 1971 for a minute because history doesn't repeat, but it sure does rhyme. August 15th, 1971. President Nixon goes on TV on a Sunday night and tells the world that the United States is closing the gold window. No more converting dollars to gold at $35 an ounce. The Bretton Woods system, the thing that had governed international monetary relations since World War II, dead overnight. You know what's fascinating about that moment? The people who saw it coming made fortunes. The people who didn't lost everything. And the signs were there. France had been converting dollars to gold for years. They literally sent a warship to New York to pick up their gold because they didn't trust the U.S. to deliver it. Germany was getting nervous. The smart money knew the math didn't work. The U.S. had printed way more dollars than it had gold to back them. Something had to give. Fast forward to today. We've got a similar setup, but it's even more extreme. Back then, at least there was some connection to gold, even if it was breaking. Today, pure fiat, nothing backing the dollar except faith in the fact that oil's priced in it, and both of those pillars are cracking. Let me tell you about the petrodollar system, because this is where it gets really interesting. After Nixon closed the gold window, the U.S. made a deal with Saudi Arabia. You price oil in dollars, we'll provide military protection. Brilliant move. It meant every country in the world needed dollars to buy oil. Instant global demand for U.S. currency. That's been the foundation of dollar dominance for 50 years. But watch what's happening now. Saudi Arabia is talking to China about pricing oil in yuan. Russia's selling oil in rubles and yuan. The UAE's opening yuan clearing houses. These aren't just headlines. These are cracks in the foundation. When countries don't need dollars to buy oil anymore, what happens to all those dollars sitting in foreign reserves? They come home. And when they come home, that's inflation on a scale we haven't seen since the 1970s. Except this time, we're starting from a much more fragile position. Here's something most people don't understand about gold. It's not an investment. It's insurance. It's the fire extinguisher you hope you never need, but you're damn glad you have when the kitchen's on fire. And right now, I'm seeing smoke. The gold to silver ratio is telling us something important. Historically, this ratio averages around 60 to 1, meaning it takes 60 ounces of silver to buy 1 ounce of gold. Right now, we're sitting around 85 to 1. That's a massive distortion. Either gold's going to come down, silver's going to shoot up, or both are going to move in ways that reflect the real supply and demand dynamics. And given what's happening in the industrial silver market, with solar panels and electric vehicles consuming silver at record rates, I know which way I'm betting. But let's get back to gold because there's something happening in the mining sector that nobody's talking about. Gold production peaked in 2018. We're not finding new deposits at the rate we used to. The easy gold's been mined. What's left is deeper, harder to extract, more expensive to process. Meanwhile, demand's going up, way up, not just from central banks, but from retail investors who are starting to wake up to what's happening. You want to know who else is buying gold? The ultra-wealthy. The people who have access to information and advisors that you and I don't. They're not buying paper gold. They're buying physical. They're storing it in private vaults in Switzerland, Singapore, places with strong property rights and political stability. They're treating gold like the monetary asset it's always been. Now, here's where this gets personal. If you've got retirement savings, if you've got a 401k or an IRA sitting in stocks and bonds, you need to understand what's at risk. The traditional 60-40 portfolio, 60% stocks, 40% bonds, that's been the standard advice for decades. But that model was built for a world where bonds provided safety and income. What happens when bonds are yielding less than inflation? What happens when both stocks and bonds go down at the same time, like we saw in 2022? You need a third leg on that stool. Something that moves differently than paper assets. Something that holds value when currencies are losing it. And historically, that's been gold. Quick aside here. And this is important if you're sitting on significant retirement savings. If you've got $100,000 or more in a traditional retirement account, there's a way to get physical gold into that account without triggering taxes or penalties. It's called a gold IRA. I put together a free guide that walks through exactly how it works, the rules, the process, what to watch out for. It's in the description below. No obligation, just information. Worth looking at if you're thinking about diversifying out of pure paper assets. All right, back to what's happening in the markets right now, because there's a technical setup forming in gold that I haven't seen in years. We've got gold consolidating just below its all-time highs. That's not weakness. That's a coiling spring. Every time gold's done this in the past, built a base near the highs, it's been followed by a major breakout. Look at what happened in 2019. Gold spent months grinding between $1,400 and $2,500. Everybody said it was topping out, then boom, straight to $2,000 in less than a year. Or go back to 2010. Same pattern. Consolidation, then explosion higher. The market's telling us something. It's building energy for the next leg up. And the fundamentals support it. Real interest rates, that's the interest rate minus inflation, they're still negative. When you can't earn a positive real return in bonds, where do you go? You go to assets that don't have counterparty risk. Assets that can't be printed, assets like gold. Here's something that should terrify you. The M2 money supply. That's the measure of all the money in the economy. It increased by 40% during the pandemic. 40%. In 2 years. That money doesn't just disappear, it's out there, sloshing around in the system, looking for a home. Some of it went into stocks, some into real estate, some into crypto. But eventually, when people realize that all these assets are priced in a currency that's being debased, they're going to look for something real. The BRICS nations, that's Brazil, Russia, India, China, South Africa, they're working on an alternative to the dollar-based system. They're talking about a new reserve currency backed by a basket of commodities, including gold. Now, will it work? Maybe, maybe not. But the fact that they're trying tells you everything you need to know about where we are in the monetary cycle. When the rest of the world is actively trying to build an alternative to your currency, that's not a sign of strength. Let me tell you about what happened in Turkey a few years ago. The lira was collapsing. Inflation was running at 80%. The government was telling people everything was fine. Keep your money in lira-denominated assets. But the people who lived through previous currency crises, they knew better. They converted everything they could into gold, physical gold. They bought jewelry, coins, bars, anything real. And they were right. The lira lost 80% of its value. Gold, priced in lira, went to the moon. That's not some distant emerging market story. That's a preview of what happens when faith in a currency breaks. And it can happen faster than you think. The Turkish lira was considered relatively stable until it wasn't. Then it collapsed in months. Now, I'm not saying the dollar's going to collapse like the Turkish lira. The dollar's the global reserve currency. It's got structural support that the lira never had. But structural support doesn't mean immune to decline. The British pound was the global reserve currency for 200 years. Then it wasn't. These transitions happen. And when they do, the people who prepared for it preserve their wealth. The people who didn't, don't. Here's what's happening in the derivatives market that should concern you. The notional value of gold derivatives, that's all the futures, options, swaps tied to gold. It's in the trillions, with a T. And it's all leveraged. When you've got that much leverage in a system, you've got fragility. One shock, one default, one major player going under, and the whole thing can unwind fast. We saw this in 2008 with mortgage-backed securities. Everyone thought they were safe until they weren't. The leverage was hidden in complex instruments that nobody fully understood. When the music stopped, trillions in paper wealth evaporated overnight. The gold derivatives market has the same structure. Massive leverage, complex instruments, counterparty risk layered on counterparty risk. The difference is when mortgage-backed securities blew up, the Fed could print money and bail out the banks. When the gold derivatives market blows up, what's the bailout? You can't print gold. You can't create it out of thin air. Either you have it or you don't. And that's why physical possession matters. If you own paper gold, an ETF, a futures contract, you own a promise that someone will deliver gold to you if you ask for it. But what if everyone asks at the same time? What if the system can't deliver? Then you find out the hard way that paper gold and physical gold are not the same thing. There's a reason why Germany spent years repatriating its gold from New York and Paris. They wanted it in their own vaults, under their own control. There's a reason why China's been building massive gold vaults in Shanghai and Beijing. They understand that in a crisis, possession is everything. Let me walk you through what a gold revaluation would look like, because this is where we might be headed. Right now, gold represents a tiny fraction of global monetary reserves. Most reserves are in dollars, euros, yen, bonds. But what if central banks decided to mark their gold reserves to market at a much higher price? What if they said, we're going to back our currencies with gold again, but at $10,000 an ounce instead of $2,000? Sounds crazy, right? But it's happened before. In 1933, Roosevelt revalued gold from $20 an ounce to $35 an ounce overnight. That's a 75% increase. And it wasn't optional. It was by executive order. The government confiscated private gold, paid people $20 an ounce, then immediately revalued it to $35. Instant wealth transfer from citizens to the government. Could it happen again? I don't know. But I know that when governments get desperate, when debt levels are unsustainable and they need a way out, they get creative. And gold revaluation is one of the tools in the playbook. Here's what's happening in the physical market right now that tells me we're close to something big. Premiums on physical gold, the amount you pay above the spot price to actually get your hands on a coin or a bar, they're elevated. Not crisis levels yet, but higher than normal. That's a sign of tightness in the physical market. People want the real thing, not paper promises. The U.S. Mint's been rationing gold and silver eagles. They can't keep up with demand. Dealers are running low on inventory. These are the early warning signs. It's like seeing the tide go out before a tsunami. The water's receding, and most people are just standing there looking at the exposed beach, not realizing what's coming. I want to talk about the psychology of this moment because that's what's going to determine how this plays out. Right now, most people still trust the system. They trust that their dollars will hold value. They trust that their bank accounts are safe. They trust that the government and the Fed have everything under control. That trust is the glue holding everything together. But trust is fragile. It's built over decades and can be destroyed in days. When people lose faith in their currency, they panic. They rush to convert paper into things: food, fuel, assets, anything real. And in that panic, prices go parabolic. We've seen it in Venezuela, Zimbabwe, Weimar Germany, Argentina. It always follows the same pattern: slow decline, then sudden collapse. The question isn't whether it can happen. History proves it can. The question is whether it will happen here, now, in our lifetime. And I'm watching the same warning signs that preceded every other currency crisis: massive money printing, unsustainable debt, loss of confidence in institutions, political instability, geopolitical tensions. All the ingredients are there. Gold's not going to make you rich overnight. That's not the point. The point is preservation. It's making sure that when the dust settles, when the monetary system resets, when currencies are revalued and debts are restructured, you still have purchasing power. You can still feed your family, pay your bills, maintain your standard of living. Think about it this way. If you had bought gold in 1971 when Nixon closed the gold window, you would have paid $35 an ounce. Today, that same ounce is worth over $2,000. That's not because gold became more valuable. It's because the dollar became less valuable. Gold just sat there, being gold, while the currency depreciated around it. That's the role gold plays. It's the constant in a world of variables. It's the measuring stick that shows you how much your currency has been debased. And right now, that measuring stick is telling us we're in trouble. The commercial banks, the big players like JP Morgan and HSBC, they've been accumulating physical gold while simultaneously shorting paper gold. Think about that strategy. They're betting against the price in the futures market while stockpiling the physical metal. What do they know that retail investors don't? They know that when the paper market breaks, when the leverage unwinds, physical gold is going to be worth a lot more than whatever the futures price says. We're living through a monetary experiment that's never been tried before. Never in history have all major currencies been pure fiat at the same time. There's no gold standard, no silver standard, no commodity backing anywhere. It's all faith-based money. And that experiment's been running for about 50 years now. In monetary terms, that's nothing. That's a blink of an eye. The laws of economics haven't been repealed. You can't print unlimited money without consequences. You can't run unlimited deficits without eventually paying the price. You can't debase your currency forever and expect people to keep accepting it. Something's got to give. And when it does, when the reset comes, the people holding real assets are going to be okay. The people holding paper promises are going to learn a very expensive lesson about the difference between wealth and currency. I'm not telling you to panic. I'm not telling you to sell everything and buy gold bars to bury in your backyard. What I'm telling you is to pay attention, to understand what's happening, to recognize that we're in the late stages of a monetary cycle that's been running since 1971. And late stages are when things get interesting. The exit from paper money isn't closed yet, but it's closing. Every day, more people are waking up to what's happening. Every day, more money flows into physical precious metals. Every day, the supply gets a little tighter and the premiums get a little higher. The smart money's already moving. The question is, are you? This isn't about fear. It's about preparation. It's about understanding that the rules of the game are changing and positioning yourself accordingly. The people who do well in monetary transitions aren't the ones with the most paper wealth. They're the ones who saw it coming and acted before the crowd. So here's what I want you to do. Look at your portfolio. Look at your retirement accounts. Ask yourself, if the dollar lost half its value over the next 5 years, would I be okay? If bonds yielded negative real returns for a decade, would my retirement plan still work? If the stock market went sideways while inflation ran hot, would I still reach my goals? If the answer to any of those questions is no, then you need to think about diversification. Real diversification. Not just stocks and bonds, not just domestic and international, but paper assets and real assets. currency and hard money, the system and the alternative to the system. Gold's been money for 5,000 years. It's survived every empire, every currency, every financial crisis. It's not going anywhere. The question is whether you're going to own some before everyone else figures out they need it too. The paper money exit is closing. Not because I say so, because the math says so, because history says so, because the people who control trillions in assets are voting with their money and they're voting for gold. You can wait and see what happens. Or you can act now while there's still time. The choice is yours, but choose wisely. Because this opportunity won't last forever.